Ganesh, good morning. Thank you for joining us. Ganesh, do you think somewhere this entire comeback trade, which is in Capex or economy, is more like a crowded trade? 9 out of 10 fund managers are bullish on it. 9 out of 10 brokerages are bullish on it now.
I'm not sure because our interactions with funds tell that there is still a fair bit of skepticism on that. There have been false starts on this in the past 10 years a few times. So there is a lot of skepticism, which is healthy. And more importantly, the foreign institutional investors are still not sold on this idea still. The domestic funds might have nibbled at it, or maybe some of them have already positioned for it, but I don't think the foreign institutional investors are sold into this idea yet. Foreign institutional investors tend to look at structural growth stories in India rather than cyclical stories. So for them, it's still consumption and increasingly even the internet stories. But cyclical capital expenditure revival stories are still not in their priority list.
It may just be a time-wise comparison, but if I look at HDFC group of companies, HDFC Bank, HDFC Life, HDFC Limited, even HDFC AMC, they are underperforming their respective peers, which is HDFC Bank is underperforming SBI, HDFC Life is underperforming SBI Life, HDFC AMC is underperforming Nippon. Why is that happening? Why suddenly HDFC group of stocks are taking a backseat?
I can't talk specific stocks or specific groups here, but in general, we are seeing a clear shift, which is in line with our model portfolio strategy as well, that cyclicals offer better earnings growth, better risk reward vis-a-vis compounders who will compound on earnings, no doubt about it, but the valuations on many of them are reckoning muted returns if mean reversion happens on multiples, and which means we will our preference in line with what market is currently displaying is a shift towards cyclicals as where the bigger returns are likely to come from.
Sure. Also wanted to understand, what is it that you are making of industrials and whether or not they offer more value? Because if I just take stock of the historical averages, the multiples are not expensive versus the market, irrespective of the steep run-up that one has seen in the entire segment all through last year and this.
See, these stocks have had a challenging down cycle for almost 10 years, and their earnings have literally not grown or might have grown low single digits compounded over the last 10 years. And these stocks have also returned pretty much similarly in this period. They've been clear laggards, so what we are now seeing is a cyclical revival for their demand. And by the way, these are good companies, they have pricing power in some sense, which is cyclical. When demand recovers, that pricing power will be demonstrated, which will show up in margins. These are companies who have seen margins come down maybe a third from their peak 10 years back. Asset turns have maybe halved. Return on capitals have possibly compressed even more. But balance sheet is still in good shape. Their market positioning is in good shape. Their product suite is well suited for the kind of likely Capex which is coming up. And competition has gotten clearly impacted. So these companies, which have not just survived, but they are sitting ready for the next cycle. And we think the cycle on industrials is clearly getting formed, led by combination of 4 variables, which are all improving in tandem, which is household capital expenditure, which is primarily in real estate or property, government capital expenditure in the form of infrastructure, corporate capital expenditure in core sectors like, say, cement, steel, renewables, to an extent lesser, but definitely in oil refinery space. So the core sector utilization, if we look at the consolidation in mind, it's not the entire sector whose capacity utilization is looking good, but it's the top few players. Could be 4 players in steel, could be 5 players in cement. Their capacity utilization has reached level where you should start expecting them to start planning for capital expenditure, and the PLI is also another driver for the non-core sectors. It could be in pharmaceuticals, chemicals, and the like. So when we weigh all these into consideration, keeping in mind the broader demand recovery that we are calling for, along with the industry consolidation and likely commodity inflationary trends, which should sustain, maybe blips here and there when supply normalizes. There could be some moderation, but longer term, when we look at the next 24 months to 36 months, keeping in mind the drivers for reflation globally, where governments are going to spend on fiscal to get the growth back on track, cyclicals, are especially quality industrials, should be favorably placed. And mind you, we are not taking next 2-3 quarters view, these will take time. But over the next 2 to 3 years, we clearly see industrials as one of the 2-3 sectors that we are very positive on how their fortunes can revive or vis-a-vis the last 10 years.
Interesting. What about spaces which have been beaten down not for months or years but decades now? Power, for instance. The government now seems to be, getting its act together, and once again a revival seems to be in place. Some of the announcements we heard from the cabinet yesterday, and it seems that in the monsoon session as well, some more reforms could be in the fray. Do you think this is one space, be it the financiers or the pure play power producers, which could finally see some light at the end of the tunnel?
Possibly, but we are not recommending it. We are not yet convinced of power sector still. We still think the sector is sitting on something like maybe 45,000 megawatts of excess capacity. And even 3-4 years out, it's likely to be in excess of 20,000 megawatts. So we are not completely clear that the power sector's fortunes are likely to improve. And we need at the distribution end, the last mile connectivity, there needs to be substantial reforms there. And that's more to do with multiple states and what states choose to do or not do. So power sector is not in our list of sectors where we are confident of things changing in our horizon of 2 to 3 years.
Ganeshram, hi, morning. Wanted to understand how you're looking at, some of the key benefits as well, like lowered corporate taxes, interest costs as well being lowered. Do you think that we are likely to see substantial gains or benefits on the back of these perks?
See, at the core for us is demand recovery. Okay, the quantum of money which has accumulated in people's bank accounts, be it corporates or individuals, contrary to the fears of pay cuts and job cuts or businesses having been impacted, our assessment is there could be lopsidedness here, no doubt about it. But what matters still is the top 30% of the population has gotten more favorably, has benefited during this pandemic, and the monies are accumulating in the bank accounts. Number one, where will that be spent? The character of accumulated savings is likely to behave differently to monthly maintenance flows, which can go into more of staples and routine spend. Whereas when it accumulates, we think the likelihood of being spent on larger ticket items or it could be leverage demand. That is our base story. Then you look at industry consolidation or the impact of inflation. We think pricing power for corporates should come, which should lead to earnings growth after almost 7-8 years of being earnings misses. Fiscal 21, it's a case in point, wherein when the year began, we all thought top lines will decline 15%. Or maybe 10%, and earnings will fall even more. But by the time the fiscal 21 ended, top lines for, say, the BSE 200, I'm excluding financials here, but say even otherwise, it fell maybe about 6-7%, but EBITDA grew 10%, and that is an important point which is to be kept in mind. The impact of demand recovery consolidation and inflation, its effect on pricing power, and couple it with operating costs being in check during this year and likely to remain for another year, means EBITDA in absolute terms, or to an extent even EBITDA margins, will see upgrades. And that is the point that we are drawing. These accumulate all these together, we are seeing it after maybe 20 years, actually. Maybe from 2003, we have not seen all these come together: demand, consolidation, inflation, and operating leverage. And add deleveraging to it, we think the story looks compelling for us. Again, all this will take much longer. It's not next 2 quarters, but eventually how earnings play out, and as a result, how capital expenditure trends will play out over the next 2 to 3 years needs to be kept in mind.
Okay, and what's the sense on the overall industry-wide capacity utilization picking up? What are the levers for growth over here, do you think, that, and what more needs to be done in order to see an incremental pickup?
Three key drivers. Household capital expenditure on real estate has its tentacles well spread. It will have an impact on cement, steel, or it could be bathroom fittings, it could be tiles, it could be the impact on pretty much everything which goes into a house. That's one. Second is if government expenditure on infrastructure, that again has its impact on cement or in fact even on labor, right? About a fourth of India's blue collar labor is involved in either in construction and infrastructure or on real estate, and that has multiplier effects into the economy. So clearly, when I see the utilization of sectors like cement or steel, while the headline industry-wide utilization figures tell one story, the top few players in both sectors their utilization levels are much higher, and that should eventually show up in how they plan for capacity expansion as normalcy returns, and the uncertainties around the COVID. Hopefully, if there isn't another wave in the next 6 months, uncertainty eventually moderates there, and that's when the true colors of all this will show up next year.
Fair enough. And, what exactly have some of the past commodity cycles of commodity inflation really indicated that could perhaps point towards the Capex recovery back home? How are you looking at the overall inflation dynamic impacting the pickup in the cycle?
Okay, on this point, we should look at inflation you should study the inflation cycles, not just in India, but globally. You realize that there is a good inflation and there is a bad inflation. Okay, there are early cycles of inflation are very good for earnings, very good for equities. Later cycles of inflation, what I mean by then, the central bank is hiking rates and he's trying to cool off the economy. So later cycles of inflation eventually hurt multiples, and with the lag after that, it starts showing up in earnings impact. Maybe I'll explain some data points out here. By 2008, the central bank in India had started getting cautious on inflation, and it started hiking rates. And maybe the financial crisis came in between. But again by mid-9 till early 11, we were seeing central banks materially hike rates in trying to cool inflation. But the impact of that started getting felt only in 2000, maybe late 11. 12 and 13 on multiples, and even after that is when the impact came on earnings front, when earnings slowed down. So we in equities need to be cognizant that the first part of inflation is good for earnings growth. It shows demand, and that's a positive. How long the early mid-cycle lasts is a judgment which we are all we need to keep our eyes and ears out and keep understanding and seeing smell it. But later cycles of inflation come back to hurt us, and that's when we need to be watchful. That we still think we are quite some time away before we need to turn cautious on inflation. And even otherwise, though we do see when the recovery in this part of the cycle, is going to be more government expenditure led globally, fiscal led globally. It will impact the real assets, the real economy, and it is going to be inflationary. The 10-year post financial crisis, the reaction was more on monetary cycle, monetary measures, which led to half the world's bond yields going to negative territory, and but inflation remained low. Whereas coming out of COVID crisis, it's going to be more fiscal led, which should be real economy inflationary. That's going to play out over the next few years. So we need to prepare ourselves for earnings getting inflated and multiples eventually getting deflated with the lag. So that's what this cycle is going to be all about.
Ganeshram, great to have you on the show. Thank you so much for taking the time out and speaking with us.
Pleasure's mine. Thank you.